Good afternoon, everyone. Ian Maddox, Hitchcock Maddox Financial Partners. As we have said in all of our videos, our goal is financial planning simplified, and sometimes providing simple definitions can be super helpful to folks. I actually work here with our local school system at the high school level through their Business Leadership Academy, and part of that department does career preparedness classes. And I was reminded, had some meetings yesterday with folks that are involved in leadership with that, and I was reflecting back on some of the classes I've taught and realized that it's not just young people that don't always know financial terms. And sometimes you may recognize what it is, but not really sure what the difference is from one thing to the next. And so starting out today, we'll continue to kind of insert some of these financial planning 101 concepts. Today, I just want to do a brief breakdown of individual securities versus mutual funds versus exchange-traded funds. In some ways, this may be a rudimentary, and you may know this. You can skip over the video, go to another one, that's fine. But for folks that maybe have been confused by some of these subjects, let me break it down very quickly. First of all, individual securities is when you own an actual piece of an investment that has been issued by a singular organization. So, for example, you may own stock in a particular company, which means you are a partial owner of that company, all right? And you get the benefits of that ownership, whatever that might mean. It could be appreciation in price. It could be dividends that are paid. Of course, when you can experience appreciation in price, you can also experience depreciation in price. It may be a fixed income. It may be a bond that's issued by an individual organization or corporation. And in that sense, you are a lender. You're almost the bank to that organization, and you are due whatever interest they have committed on that security issuance. So if there's an interest rate that is stated, that is due to you as a lender to the organization that issued the bond. Of course, again, you can expose yourself to a rise or a drop in price of that security. Now, we get into the realm of baskets of investments, okay? Many decades ago, the idea was, well, it's kind of hard to just pick and choose individual securities, so folks back in the 1930s came up with ways to pool assets together with a management team and buy multiple securities, multiple stocks, multiple bonds inside of one investment vehicle that then could issue shares to its shareholder, and you would experience all the same things but in a diversified way. That was called a mutual fund. Makes sense. It's a fund, a basket of investments. It's mutual, so it's collective, and we all can go out there and buy them. So, great vehicle. It's been a huge piece of the investment strategy of many investors inside of their retirement plans at work, with their own investments, et cetera, et cetera. One of the downsides of a mutual fund is that it can only be priced at the end of the day. So all of the buys and sells are tallied, and then you get what's called the net asset value. The price is recalibrated at the end of the day. Nowadays, with technology the way it is, some people like the flexibility or the freedom to be able to buy and sell intraday. That's where the ETF came in, the exchange traded fund. It is still a basket of investments. Many times it's just tracking an index. So there's an underlying measurement tool that says, hey, we're going to measure the prices of these securities, and that is where we'll derive our price from. And they can be sold intraday. So it was kind of a financial advancement. It was financial engineering that brought these things to the foray, but it allowed people now to get in and out of the security during the middle of the trading day, which some people appreciate. The other advantage, in many cases, not all cases, but in many cases that an ETF has over a mutual fund is a lower expense ratio. It's less costly. The downside, potentially, to an ETF is that there's no management structure, right? With the mutual fund, there's a team of people that are buying and selling towards a particular goal, whereas the ETF, in many cases, or most cases, is just following a static index. So anyways, that's the differences. Individual securities is what goes into the mutual fund, and the ETF in some way, shape, or form. How you use those tools is completely up to you and your financial plan, the needs that you have. Always encourage folks to check with a professional. Good to see you. We'll look forward to catching up again next week. Shoot your questions our way in comments. You can respond via email from our website. Ian Maddox, HMFP. Talk to you soon.